Welcome to our deep dive into financial engineering, a fascinating and complex area within finance that blends advanced mathematical and computational techniques to solve financial problems. Whether you're an aspiring finance professional or a seasoned expert looking to refresh your knowledge, this comprehensive guide covers everything you need to know. Financial engineering, sometimes referred to as quantitative finance, involves creating new financial products, instruments, and strategies using mathematical models. It draws heavily from disciplines such as finance, economics, mathematics, statistics, and computer science. To start, let's look at the core principles and tools of financial engineering. One of the foundational concepts is the Black-Scholes model, used to price European-style options. Let's break down this equation. C is the call option price. S_0 is the current price of the stock. N, D_1, and N, D_2 represent values from the cumulative normal distribution. X is the strike price. E is the base of the natural logarithm. R is the risk-free interest rate. And T is the time until the option's expiration. Now, imagine you have a European call option on a stock currently priced at $100. With a strike price of $100, a risk-free rate of 5%, and 1 year to maturity. If the stock has a volatility of 20%, you can use the Black-Scholes formula to calculate the option's value. Here's how the numbers plug into our formula. Using these inputs, we calculate D_1 and D_2, then retrieve N, D_1, and N, D_2 from standard normal distribution tables. Eventually, we find the option value to be around $10.45. Financial engineers use many such sophisticated tools and models. Another popular method is Monte Carlo simulation, widely used to model the probability of different outcomes in processes that are difficult to predict due to random variables. For example, Monte Carlo simulations can model stock prices. By repeatedly running simulations to generate thousands of possible price paths, financial engineers can better understand the risks associated with a stock and develop appropriate hedging strategies. One of the essential elements in financial engineering is risk management, which involves identifying, assessing, and prioritizing risks, followed by coordinated and economical application of resources to minimize, monitor, and control the probability or impact of unforeseen events. For better understanding, consider Value at Risk, VAR, a risk management tool that measures the potential loss in value of a portfolio over a defined period for a given confidence interval. Say we have a portfolio that has a VAR of $500 at a 95% confidence interval over 1 day. This means that we can expect to lose $500 or more on one of every 20 days, or 5% of the time. Now let's talk about algorithmic trading, another significant application of financial engineering. Algorithmic trading utilizes algorithms to make trading decisions, execute orders, and manage portfolios automatically, thus reducing the need for human intervention. By combining models of financial markets with sophisticated algorithms, traders can exploit arbitrage opportunities while minimizing risk. For instance, high-frequency trading, HFT, strategies execute orders within milliseconds to capture minimal market inefficiencies. These strategies rely on both speed and accuracy to be effective. Let me illustrate this with an example. A high-frequency trading firm identifies a brief pricing discrepancy between two exchanges, Exchange A and Exchange B. By quickly buying the underpriced asset on Exchange A and selling the overpriced one on Exchange B, the firm can secure a profit in a matter of milliseconds. Moreover, financial engineering plays a vital role in the development of credit derivatives, such as credit default swaps, CDS, which allow investors to manage their exposure to credit risk. For example, a company may use a CDS to ensure their bond holdings against default by the issuer. If the issuer defaults, the seller of the CDS compensates the buyer, thus offering a layer of protection against credit risk. In addition to these tools and methods, financial engineers must also be well-versed in programming languages and data analysis tools. Languages such as Python, R, and MATLAB are commonly used for building and backtesting models. For example, using Python with libraries like NumPy and Pandas, you can handle large datasets and perform complex numerical computations efficiently. Here's a snippet of how you might simulate a simple geometric Brownian motion, which is often used to model stock prices. This equation models the stock price S, T, at time t, where S0 is the initial stock price, mu is the drift coefficient, sigma is the volatility, and WT is a Wiener process or Brownian motion. In practice, here's a simple Python code snippet to simulate this. As you can see, financial engineering is at the intersection of multiple disciplines and requires a combination of theoretical knowledge and practical skills. From pricing financial instruments and risk management to algorithmic trading and credit derivatives, financial engineers utilize various tools and methodologies to innovate and solve complex financial problems. This brings us to the end of our detailed exploration of financial engineering. Thank you for joining us. Don't forget to like, comment, and subscribe for more in-depth tutorials and insights. Until next time, happy learning!